Hey everybody, what's up? Sorry I'm late today. I was busy. Busy. But now I have time to do this video. Look at the dollar, huh? The other day, dollar yen up above 115, now in the 112 handle. Up above 115. Then they raised interest rates, and what happened? Oh, dollar went down. Gold's up, stocks off a little bit. All right. I want to talk about something very interesting development. In the past, and my main focus is on the fiscal flows, government spending. I mean, the report that I put out, MMT Trader, is very much focused on that. All the analysis and the analytical work that I do, it incorporates the idea or the reality of fiscal flows. And very often, the growth rate, the year over year growth rate in the fiscal flows, very closely correlates to the growth rate in the economy. And why shouldn't it? When the government spends, that flows to income, to the income and savings of the non-government, right? When the government spends, somebody's getting the money, an individual or a firm, somebody's getting the money. And national income equals national product. In other words, for everything made, somebody gets paid. So the growth rate in that savings very closely correlates to the growth rate in the economy. And you could see it. I mean, last year, the growth rate was, I guess, around 2.7%. We had something like a 3% or just under a 3% growth rate for the year. Now, here's what's interesting is that in the first quarter and by the way, I've been telling all of you that the fiscal flows have slowed down to a crawl since the fiscal year began, which was October 1st of 2016. We had a period there from the end of December for a couple of weeks that it ramped up pretty strongly, but then it slowed down once again, and basically the growth rate of the fiscal flows, that is the year over year growth rate, is now about 0.75%. That's it. Last year at this time, we were up around 3% growth year over year. Now it's only 0.7. So the other day in an article I posted up on Real Money on thestreet.com, I said that my forecast for first quarter GDP growth was going to be about 0.7, I said 0.73%. And I based that on the growth rate in the fiscal flows. And guess what? I just find out today, if you look at the Atlanta Fed publishes this thing called GDP Now, which is their GDP forecasting tool, widget, whatever you want to call it. You can get it in the St. Louis Fed's, the FRED database, F-R-E-D, their FRED database. You can get that online. Those of you who have taken any of my courses, the Forex course or Understanding the Daily Treasury Statement, or even the MMT Value Stock Selection course, I talk about how to access the St. Louis Fed's database. It's a fantastic resource. It's free. They got something like 60,000 economic metrics and things on there, and you can manipulate them and make your own functions and everything. Anyway, this GDP Now is now forecasting a 0.9, very close to what I said. Okay, so I don't know if they're looking at the same thing, but they're now forecasting a 0.9% growth rate in the first quarter. Now, number one, that would be down from a 1.9% growth rate in the fourth quarter, which already was kind of weak. And the fourth quarter was down from a 3.5% growth rate in the third quarter of last year. So we have a slowdown in the fourth quarter. It looks like we're barely going to be above zero in this first quarter, yet stocks are very close still to an all-time record high. Why is that? Because I am way ahead of everybody else. The mass of investors, they don't pay attention to these kind of things. They trade or invest off of pure either guessing or it's gambling to them, or it's some story they heard about, like Trump's going to do tax cuts, big things, big things, and it's highly emotional the way they behave. Not me. All right, so the growth rate is collapsing in the economy. It is flat, pretty much flat in the fiscal flows. Yet everybody is still very euphoric about stocks. I'm telling you right now, just as I was right on everything else with the dollar and all this other stuff, we are in for a big correction. And it might be something even more important, if I could use that word, than a correction. It might be something far deeper and longer lasting and based on a fundamental retrenchment in the economy where there is not going to be the response. Don't think Trump's going to be riding in like, the Lone Ranger on his horse saying, hey, we're going to do a massive fiscal stimulus. No, you see this guy's budget. He's cutting and slashing everywhere. And supposedly we'll see an increase in military spending, but at best, the budget is neutral. At best, it's neutral, okay? Which means no change from the reality that we are seeing right now, and the reality which investors will eventually wake up to, believe me. All right, everybody, that's it for now. See you later. Bye-bye.